Have you ever found yourself staring at a chart in a bear market just feeling completely lost? Well, you are in exactly the right place. Today, we're going to move way beyond guesswork and dive into a really structured, top-down way to find those high-probability selling opportunities. Welcome to AI Explains ICT. In this video, we are breaking down the powerful concepts for trading bear markets from ICT's core content, Month 6, Episode 5. And trust me, you are going to want to grab a notebook for this one because we're about to cover some seriously detailed, actionable strategies that you'll definitely want to remember. So, here's what we've got on deck today. First, we'll cover the big picture strategy. Then, we'll dive deep into the core principle of time frame alignment. After that, we get our hands dirty mapping out our charts and figuring out how to execute trades. And finally, we'll wrap it all up with the key takeaways you need for success.
All right, let's kick things off with the right mindset. See, trading in a bear market, it's not about trying to catch a falling knife or randomly guessing where the bottom is. No way. It's about a systematic, top-down analysis that's designed to stack the odds heavily in your favor. And this right here, this is the absolute foundation of the entire strategy, time frame alignment. We start with the biggest picture possible, the monthly chart, and only then do we work our way down. When those huge time frames are telling you the market wants to go lower, our only job is to find the best possible spot to hop on for the ride.
So, let's really get into the nitty-gritty of what makes this whole thing work. What are the exact conditions we're on the hunt for? Well, it all comes down to finding specific zones on the chart where the big sellers are most likely to step in and push the price down. And that brings us to a really critical idea, the premium PD array. Okay, the easiest way to think about this is like this. It's a predefined price level in what you could call an expensive market. It acts almost like a magnet for sellers. So when the price rallies up into one of these zones, it's a huge red flag for us to start watching for a potential short trade.
So what do these PD arrays actually look like on a chart? Well, according to ICT, they show up in a few different forms. We're looking for stuff like old highs, and especially patterns like a bearish order block. That's usually the last up candle right before a big, sharp move down. Or maybe a fair value gap, which happens when price moves so fast it leaves an imbalance. These are the kinds of footprints we're going to be looking for.
And right here, this is the perfect storm for a seller. This is what you'd call an A+ setup. It's when the monthly, the weekly, and the daily charts are all pointing down. I mean, when you find this kind of alignment, it's telling you that every little rally is a potential selling opportunity, and you've basically got a hurricane-force wind at your back.
Okay, theory is one thing, right? But let's actually see how this looks on the charts. It's time to map out our strategic levels. Think of this as identifying the battlefield on those high time frames long before we would ever even think about placing a trade.
Okay, first things first, we always start with the monthly chart. In a really strong bear market, every single one of those green up candles, well, it represents a failed attempt to rally. So ICT teaches us to mark the lows and the open prices of these candles, just like you see with the blue lines here. These levels become our highest level map of potential resistance. Next up, we drop down to the weekly chart. We keep those monthly levels on our chart, but now we add another layer of detail. We're looking for any weekly bearish order blocks. Remember, those are the last up candles before a big drop. And for even more precision, we can mark the 50% level of that candle's body, what ICT calls the mean threshold, as a really key trigger point. Now here's where it gets really interesting, this idea of convergence. When you see a weekly level line up perfectly with a monthly level you've already marked out, that area becomes a supercharged zone of potential resistance. The more levels that overlap in one spot, the higher the probability that the market is going to react there.
Okay, so we've done our strategic homework, we've mapped the battlefield, and we know exactly where the major resistance zones are. Now it's time to switch hats, become a tactician, and find that precise entry on a lower time frame.
And this is where it all comes together. We take all those powerful monthly and weekly lines we drew, and we just copy them right onto our 4-hour chart. This is our execution time frame. See, we're not guessing anymore. We are patiently waiting for price to come to one of our pre-identified zones.
So what's the actual trigger for the trade? Well, once price finally pushes up into one of our high time frame zones, we zoom in on that 4-hour chart. And now we're looking for a new bearish pattern, like a fresh 4-hour bearish order block to form right at that level. That is our confirmation. That's our signal to even consider entering a trade. Just take a look at this textbook example. You can see price rallies precisely up to that area where the monthly and weekly resistance levels converged. Then, right at that level, it forms a crystal clear 4-hour bearish order block. And boom, the price just falls off a cliff. This is the model in action. Strategic patience followed by tactical, precise execution.
And listen, this is so important to remember. No system is foolproof. ICT himself is extremely clear about this. Sometimes a pattern that looks absolutely perfect is going to fail. And that's not a flaw in the model, it's just the reality of trading in the market. So let's be realistic here. The winning setups, they're the ones that line up perfectly with that high time frame story and show a really clear, decisive rejection at our key levels. But losing setups, they're going to happen. They're just the cost of doing business in this game. The key isn't trying to avoid every single loss, because you can't. It's about having a solid plan and managing your risk when they do pop up. Wow, we have covered a ton of ground, haven't we? We went from high-level theory all the way down to boots-on-the-ground execution. So let's boil all of that down into a simple, straightforward checklist that you can use.
Okay, here's your final checklist. First, always remember the biggest moves start on the highest timeframes. That's your catalyst. Second, look for those sweet spots where multiple levels converge. Third, use the 4-hour chart to patiently wait for a refined, lower-risk entry. Fourth, in a bear market, you have to treat every single rally with suspicion. And last but definitely not least, expect and manage your losing trades. They're just part of the game.
And that just about wraps it up, but I want to leave you with this one question to really think about. How are you going to apply this patient, top-down analysis into your own trading process? Because the real power isn't just in knowing this information, it's in actually using it.
Hey, if you found this breakdown valuable, hitting that like button and subscribing to the channel is always massively appreciated. It really helps us make more videos just like this one.
And of course, if anything was unclear or if you just have a question, please drop it in the comments below. We actually read and respond to every single one.
Thanks so much for watching, and as always, safe trading out there.